Hello, everyone. Sorry for the delay. We're experiencing a little bit technical difficulties, so sorry for the being late. For let's start, but we will jump in right away in a moment. Okay. Welcome, and I'm glad you made time for this because today we'll be talking about finishing the year strong. And if you like most owners, Q4 feels like a race. You're closing projects, chasing receivables, trying not to overpay the IRS. And nobody plays by different rules. The people just use the rules on time. And that's what we are doing here. Over the next 45 minutes, I'm going to hand you a simple Q4 playbook, let's call it like this, with the 10 moves that you make before December 31st to keep more of what you have already earned. And these are not theory, those are practical legal steps that can put thousands back in your pocket and make April much calmer. And I will keep it simple, try to say it in plain language, and will show you where the real dollars hide. And that not everything will apply to everyone. So your job is to circle one or two moves that will fit your situation and actually implement them before the year is over. By the time we wrap it up, you will know exactly which levers to pull, so you keep more of what you made in 2025. So grab your notebook if you have one to take notes, and let's get you a stronger finish to the year. First, I will tell you very quickly about us and how our services are slightly different, I would say, than other CPA firms. And then I will explain what tax planning actually is and how it differs from traditional services that 99% of CPAs are actually offering. And we have a history in the industry of offered in the past. Also, I prepared 2 case studies that shows examples of how we helped 2 of our clients, and I will go over strategies that we implemented for them as well, as well as saving generated as a result. So you could see, just have a better idea of what tax planning can bring you and what it is all about. Because again, our industry, accounting, taxes are not known for tax planning. It's mostly been known for years for compliance to file tax returns. And finally, I will go over practical legal steps that can put thousands back in your pocket and make April much calmer. At the end, if we have time, I would glad to answer your questions. Okay. Before we dive deeper, I want to share something special that we prepared just for you as an attendee. We are offering a free diagnostic meeting with a CPA where we will review your latest tax return for missed opportunities and look at your overall tax situation. From that, we will give you an estimate of the tax savings available to you. The diagnostic is completely free, no string attached, but here is the catch: you need to book it before the webinar ends. And again, it's a meeting with the actual CPA that will go over your specific situation. As a bonus, if you decide to move forward with us and with our services, and you will become our client, we'll also include you between $750 to $1,500 of your fees on acceptance for strategy sessions, because that's how we start. When we start working, we put together a strategy for you to go with, and it has a fee for that attached. So we will give you a discount on that if you again book before the webinar ends. Okay, so custom accounting, as I mentioned very quickly, we are not just traditional CPAs and enrolled agents. We are actually designated tax strategists who specialize in proactive, forward-thinking tax reduction planning. What makes us different is how we design and implement customized, innovative strategies that save our clients tens of thousands of dollars every year using only IRS-approved and court-tested methods. We bring cutting-edge knowledge, advanced planning tools, and over 15 years of experience to help successful business owners, entrepreneurs, doctors, and real estate investors legally minimize their taxes. And the result, they pay the least amount of tax legally possible and often see a 200, 300 ROI on your tax planning investment with us. Throughout the years, we have invested thousands of dollars to learn from leading tax experts across the country, investing in professionals, with coaches in programs and events to ensure we master the process the right way. And we hold elite and unique certified tax coach and certified tax planner designations that less than 1,000 other tax professionals have the privilege in obtaining in the entire United States. And in the last 3 years, we helped to reduce our client taxes by over $4 million through leveraging tax code and implementing basic and advanced tax strategies. Most business owners don't realize that there is a huge difference between tax preparation and tax planning. But think of it this way. Tax preparation is looking in the rear view mirror. It's backward looking. Your CPA takes your prior year's numbers, files the return, and makes sure you're compliant. But at that point, history is history. There is almost nothing that you can do to reduce your tax bill. And that's how most accountants operate still, even now, even though the trend is changing, but it's still how the most accountants operate. Reactive, not proactive. And tax planning, on the other hand, is like having a GPS. It's forward-looking. It takes into account your business, your life, your goals, and the tax code before year-end, while there is still time to make changes. And that's where the real savings happen. So while tax preparation is just compliance service, tax planning is one of the smartest investments with a massive ROI you will ever make. It leverages the law to help you pay the least amount of tax legally possible, year after year. Most CPAs, tax preparers, accountants save you very little on the largest expense of your life, which is taxes. Instead, they just preparing your tax return. Therefore, tax preparation is a cost, something you have to pay to comply with IRS, while tax planning is an investment that has the highest return on investment that you can possibly get elsewhere. To put it in perspective, if you invest $1, doubling 20 times tax-free, you will end up with 1 million as shown on the left. However, if we take into account taxes at assumed, let's say 25% tax rate, you will only end up with $72,000. Huge difference. 1 million versus $72,000 due to taxes. So this illustration shows you how taxes are our biggest expenses of our lives. It also shows that without tax planning, the more you make, the more you pay in taxes. Now, let's go over 2 real case studies that shows how we are helping our clients to reduce their tax burden. Here's Josh, a 35-year-old dentist. Like many other business owners, he loved his accountant. And he filed his tax on Schedule C of his personal return and overpaid the IRS every single year. So the very first year he started to work with us, we were able to reduce his tax bill by $37,000. And we continued to deliver around the same savings for every year going forward. And we didn't change his lifestyle. In fact, we lowered his audit risk at the same time. And the major savings came from the advanced entity structure that we suggested for him. We helped him restructure into two separate entities, one S corporation for dental products and one C corporation for dental services. That allowed us to shift income into lower tax brackets. His personal brackets dropped from 30 to 20, and C corporation portion was taxed at a regular. Structuring a loan saved him over $21,000. Additionally, we did owner compensation study where we determined reasonable salary that Josh should pay himself. The salary was calculated to ensure it is reasonable in eyes of IRS, but also, very important, minimize taxes due for Josh. It was calculated based on our tax and industry standards. And this not only minimized his taxes, but also provided audit protection. That saved him another $6,500. Because we lowered his taxable income and optimized his reasonable salary, he now qualified for qualified QBI, qualified business income deduction, saving him additional $3,500. And finally, we found few missed business deductions that were not claimed by Josh previously. For example, he was not claiming depreciation of his home office, as well as cleaning services he paid for to clean his home. That was additional $6,000. So in total, Josh saved $37,000 in 1 year, and plus another $6,000 to $8,000 at the state level. And here is the best part. Those savings will grow as his business grows. Now, let me ask you, what would you do with an extra $30,000 to $40,000 back in your pocket every single year? Let me show you the long-term impact of just 1 year of smart tax planning. Josh saved $37,000 in taxes in year 1. Instead of sending those money to the IRS, let's imagine he invested it. At a conservative 9% return over 30 years, from age 35 to 65, that $137,000 grows to nearly $500,000. And here is the key: to do it once. Just by keeping money, he was already losing to taxes. Now imagine if you found an extra $30,000 to $40,000, not just once, but every year. That's not just savings on taxes, that's building long-term wealth. And that's the power of tax planning. If we take a step further, if Josh didn't just invest once, 1 year, but instead invest every year for the next 30 years, his tax saving alone would grow to almost $5.5 million by age 65. Those are two extremes. On one hand, and he's investing just once. On the other hand, he's investing all savings. But the truth is, you don't have to do either extreme. Even if you invested just 30 to 50% of your tax savings every year, you would be still setting yourself up for a secure and comfortable retirement. And again, that's the power of turning tax planning into wealth building. Now, let me tell you about George, who is a second client of ours, who I would like to talk about today, who is a software development, and he's 42 years old. So he came to us while still having his accountant to file his taxes. And he told that he loved his accountant, that he had been with him for 10 years. And first year, we simply did a comprehensive tax plan for him, but he stayed with his accountant to file his taxes. Even though his annual fee with his former accountant was not huge, he was mainly paying for tax preparation, and that mistake was costly. George ended up overpaying $31,450 in just 1 year. Multiply that by a decade, and it's over $314,000 lost to IRS. And here is why. His accountant was simply filing returns, looking backward. Without applying proactive strategies, George was getting exactly what he paid for: compliance, not savings, which is important, but it was not tax planning. So what did we do for George to save things around? We applied 5 core strategies and saved him $31,500 in the very first year. We showed him how to generate tax-free income worth about $6,000 annually. We implemented Section 105 health reimbursement plan, so his business could pay for his family's health insurance premiums and all other medical expenses pre-tax. And that alone reduced his taxable income and saved nearly $10,000 per year. We helped him to open solo 401k and contribute $20,000, which saved him additional $4K annually. Plus, it gave him options for self-directed investing and even up to $50,000 in accessible tax-free loan funds. And that's the power of solo 401k, which not many people knows. Then we suggested he hire his son to work for the business, which created another $3,700 in savings. And finally, we identified that he qualified for R&D, research and development tax credit, brought in another $8,000 in tax savings. So the result, we turned a pattern of 6-figure losing to IRS into tens of thousands in annual savings. So the takeaway here, staying loyal to the wrong advisor doesn't just cost you their fee. It can drain thousands of dollars from your wealth without you even realizing it. So ask yourself, if George was overpaying $31,000 every year, how much might you be leaving on the table if you still utilize traditional CPA services, which mostly concentrate on compliance, filing taxes? Okay, let's start with our 10 strategies that we will be covering today. And let's start with something that quietly moves the needle for a lot of owners, which is setting the right S-Corp salary. What you pay yourself as W-2 salary is hit with payroll taxes. What you take as owner distributions is not. So our goal is a salary that is reasonable, high enough to satisfy the IRS, but not higher than what you need to pay. So more of your profit this way can come out without payroll tax. In real life, getting this right can mean thousands back in your pocket. We commonly see savings in the $8,000 to $20,000 range over a year, depending on the business. So say your business nets $100,000, the bottom line. As a sole proprietor, you would pay about $14,000 in self-employment taxes. As an S-Corp, if you pay yourself $50,000 in W-2 wages, the combined payroll tax on that salary about $7,650. The other $50,000 you take as a distribution, no payroll tax on that part. So that one change is roughly $6,480 in pure payroll tax savings. Same work, same profit, but smarter structure. So the rule is we want to satisfy IRS, so IRS doesn't go after because you're paying yourself not enough, but at the same time, you don't want to have a high salary to overpay in payroll taxes. So the lower you set the salary, the more you save. If you set it too low, though, the IRS can argue it wasn't reasonable and push back for back tax and penalties. So again, to stay safe, think of reasonable compensation as fair market value. What you would pay someone else to perform the same duties you perform for the business. And there are a few red flags to avoid. One of them, taking distributions while taking no salary in a profitable year. That's asking for IRS later. If the company isn't profitable, you generally don't need a salary, but then don't take distribution either. The practical next step before your last payroll of the year, check where your salary is landing. A small year-end adjustments can put you exactly where you want to be, so you close the year in a better shape. Keep more, stay compliant with a salary that truly fits your situation and your business and minimizes the taxes that you pay as a result. Next one, health insurance is one of those lines on the budget that never seems to shrink. Since we are all paying it anyway, I want to make sure you get the deduction that you're entitled to without losing it to the paperwork. And let me start with S corporation, because this is where people miss easy money. If you own 2% or more of an S corporation, two things simply have to happen before year end. The company needs to pay or reimburse your premiums, and that amount must land on your W-2. When both are true, you take the self-employment health insurance deductions on your personal return. When they are not, you are stuck with the itemized medical rules. And that 7.5% of AGI requirement can erase a lot of savings. So if you're S Corp, think of December payroll as your friend. Get it on the books and on the W-2, and you're good. Now, there is another tool that's incredibly helpful outside of S Corp. It's a Section 105 HRA. It's just a simple medical reimbursement plan for employees. Because it's an employee benefit, someone actually must be on a payroll, employee. For a sole proprietor or partnership, that often means hiring your spouse as an employee and covering the family through their plan. Those reimbursements become clean business deductions. In a C Corp, it's even simpler. You're an employee of your own corporation, so the plan works right there. You don't need to hire a spouse. You will pay it yourself as an employee. And you will establish health reimbursement plan on your name. Inside an S corporation, though, you and your spouse, unfortunately, do not qualify for 105 plan. And therefore, we use the W-2 method that I just talked about at the beginning of the slide. Or again, you can run a 105 if you have an S corporation, you can run a 105 plan through a different entity type that fits the rules. So you might need to have two entities whenever it's appropriate. So here is the part that most people don't realize. If the reimbursements under 105 HRA count as fair compensation, they can be the only pay that your spouse receives. In a spouse-only setup, that means no payroll tax filings. The reimbursements are the compensations. So basically, the reimbursement for health insurance and other medical expenses for the whole family can serve as a pay without setting up actual payroll. And it's not just for spouses. Picture a single mom running a real estate business. She hires her teenage son to help. Flyers, data entry, lockbox, and the plan can reimburse his eyeglasses or his orthodontics. You can even hire a retired parent to help with admin work and use the plan to cover their medical costs. The key is simple. Make them your real employees, keep light documentation, and reimburse on a regular rhythm. Two timing notes so you don't lose the year. First, as corporation owners, make sure the premiums run through the company and are on the W-2 before the last payroll. Very important. Second, 105 HRA users, sole proprietors, C corporation, partnerships, make the reimbursement before 12/31. You generally cannot go back and pick up expenses from before the plan existed or before the employee was covered. With the right setup for your entity, you can deduct family health insurance and other medical expenses as a business expenses and save thousands of dollars. Let me share another small little win, not sometimes can be big, not always small, that helps a lot of owners at year end. The pass-through entity tax election, or PTIT. In plain English, PTIT lets your partnership or S corporation pay your state income tax at the business level instead of you paying it personally. When the business pays it, it becomes a business deduction. That lowers the income that shows up on your federal return. Your AGI drops, so the same state tax dollars suddenly works harder for you. Here, how it feels with real numbers. Imagine the business will end the year with $300,000 in profit, and your state rate is, let's say, 5%. If the entity pays $15,000 as PTIT, your federal taxable income is about $15,000 lower. At roughly a 24% bracket, that's around $3,600 in federal savings. Same state tax, just paid a different way. The part that trips people up is timing. Different states have different mechanics, but there is a simple year-end rhythm that keeps you safe. Get the PTIT paid by December 31st if you want the deduction to count for this year. Many states let you file the formal election with the return later, but the payment is what locks in the federal deduction for this calendar year. So December really matters here. A simple year-end payment is often all it takes to capture the deduction now. Rule of thumb, if your business will show profit for the year and it's set up as partnership or as corporation, you can benefit and reduce your tax bill by implementing PTIT. You know how every December we look at numbers and say, I wish there were one big move I could make, cut my tax bill before the year close. And that's solo 401k. One thing that people don't realize, you don't have to put all the money in by December 31st to benefit. You just need to have the plan set up by December 31st. The paperwork, the account open, and that's it. Once it's in place, you can take your time funding it all the way until your tax deadline next year, which is April or even maybe October. But if you miss December 31st, the door is closed for this year. So that's why this is a year-end move. And the power of this tool is incredible. With Solo 401k, you are both the employee and the employer. That means you get to wear two hats and contribute in both roles. As employee, you can contribute $23,500 or over $31,000 if you're 50 or older. And then as the employer, your business can add roughly another 25% of your pay on top. All told, you can shelter up to around $70,000 this year, or even more if you're over 50. That will reduce your tax bill by around $30,000. That's money that doesn't go to the IRS. Instead, it goes to your future. Huge difference. So here's the bottom line. If you're running your own business and you don't yet have a solo 401k, December 31 is the make or break date. Get it set up now. And even if you don't put a dime until later, you're fine. You're locked in one of the most powerful year-end tax strategies available. And another one we'll be talking today about is something that can also help you save thousands, but often missed, is getting reimbursed for depreciation expense of your personal assets. Specifically, everyone heard about the home office deduction, right? But here is what most people completely miss, is the depreciation part. That's where the real money is. When your business reimburses you for using part of your home, it can reimburse not only for things like rent, utilities, cleaning, but also for depreciation, which is basically wear and tear of your home. And here is the best part, depreciation is non-cash expense. So you don't actually pay that money out, but your business can still reimburse you for it. That means you're literally moving cash from your business to yourself, tax-free, for an expense that you didn't even actually pay. Of course, to benefit from this, you need to own your home you live in. So that's the only when you can depreciate it. If you're renting it out, it's unfortunately will not be available to you. So, but let me give you an example. Say your home is 2,000 square feet and your office is 200 square feet, which is 10%. So your business can reimburse you for 10% of your rent, mortgage, interest, utilities, and so on, cleaning expenses, and so on, as well as 10% of your home depreciation. Now, let's say your home cost $500,000. The depreciation on that could be around $18,000 per year. 10% of that is $1,800. And that's just from depreciation alone. That's $1,800 of cash that your business can pay you tax-free just for letting it use part of your home. You didn't actually pay that $1,800 to anyone. It's just a paper expense, but you still get the cash, tax-free. No taxes being paid on that amount. As year-end hits, total your car, your phone, your home office, and reimburse yourself for depreciation expense before December 31. And again, not just obvious bills like gas, internet, phone, but specifically depreciation expense as well, as that's where bigger dollars hide, and that's what oftentimes missed. Okay, next one. Sometimes the little things really help morale, and the tax code makes room for that. Small occasional non-cash gifts, flowers, fruit basket, book can be tax-free and deductible when they are low value and not frequent. That's the de minimis fringe rule. How to use it in real life? Keep it small and occasional. A thoughtful $50 to $70 bouquet for an illness, a fruit tray to celebrate a big win, a book for outstanding effort, perfect. There is no official dollar cap. The spirit is too small to track and not something you do every week. It's not just employees who can enjoy these small tax-free gifts. If you operate as a sole proprietorship or a single member LLC taxed that way, you may qualify for the same treatment as an employee of yours. If you as corporation owner, you are employee of your corporation, you qualify again. Picture this, it's your birthday, you order yourself a terrific fruit basket, tax-free to you and deductible to the business, and you or the business can also deduct small tax-free candy, flowers, or fruit given to corporate directors or independent contractors. So it's either your employees, you, or partners, you can benefit deducting these fringe benefits. One trap to avoid: gift cards or anything that works like cash. So those are taxable even in tiny amounts, and they lose the tax-free treatment. So why this matters? It's a simple way to show care. Someone feels seen, they don't get taxed on it, and the business still gets the write-off. Year-end step: set a small and occasional guideline, skip gift cards, and jot a one-line note on why the gift was given, so your books tell a clean and human story. And reduce your taxes by doing so. Here is the simple move most couple miss. If one of you truly runs the business and the other helps, don't rush to pay your spouse W-2 wages. Instead, make your spouse a real working employee and reimburse their medical expenses through the business. Why this matters? W-2 triggers FICA payroll tax and are taxable to your spouse. Proper medical reimbursements are tax-free to your spouse and deductible to the business. So the same dollars do more work. It feels like taking a bill you are going to pay anyway and letting the business pick it up. If you prefer, you can still pay a small W-2 amount to your spouse to make the employment visibly documented in payroll records, but it's not required when medical reimbursement are the primary compensation. A quick picture, say you were thinking of paying your spouse $25,000 in wages. Swap most or all of those $25,000 of documented medical reimbursements instead. And you've just avoided a payroll tax on that amount and turned family medical costs into a straight business deduction. Often that's thousands saved without changing anything. But keep it real and simple. Your spouse should actually do the work. Jot quick weekly timesheets and keep a short plan document so reimbursements are by the book. That's important, but that's it. Nothing major, just a smarter way to support your household with the business. If the year-end step is easy, put your employee spouse set up in writing, start the timesheets, and reimburse eligible medical expenses before December 31st. So the deduction lands this year. And here is a quick gut check for Schedule C business owners. Does that 15.3% self-employment tax feel like it eats your wins? And here is a simple thing that can ease the bite. If you own the office or workspace that you use, you can have your spouse own the property instead, and you rent it from them. What that does is move part of your profit off Schedule C, where self-employment tax hits, and it moves to Schedule E, where there is no self-employment tax. So same family, same money, just routed smarter way. Let me show you an example. Say your business nets $100,000 and you pay your spouse $2,000 in a month in fair rent. That shifts $24,000 off Schedule C and over to Schedule E, trimming self-employment tax by about $3,400 for the year. You still pay regular income tax, but that self-employment tax is real cash that you keep. A few common sense rules that make this solid. Your spouse needs to actually own the property. 50% at least works, but 100% would be the best. You set fair market rent and you treat it like a real lease. Written agreement, monthly payments, separate account, and have a non-tax reason on paper. Liability protection, clean bookkeeping, or giving your spouse a real income stream. All those are great, normal, sensible reasons to have why you moving the rental property to a spouse. So year-end step, make sure title shows your spouse as an owner or co-owner. Sign a simple lease at fair rent and start actual rent payments before December 31st. So the savings count this year. Let's do a quick year-end cleanup that actually feels good. First, stop paying tax on money you will never see. If a customer is not going to pay, write off the bad debt and move on. Same with obsolete inventory. That's collecting dust. Document it and scrap it. That's relief you can feel. Next, de minimis safe harbor is your friend. Instead of capitalizing little stuff forever, set a simple policy, say anything below $2,500 gets expensed. and put small tools, equipment, and repairs straight to expense instead of depreciating. Next point. If you are cash basis, the 12-month rule can pull deductions into this year. Repay up to 12 months of things you already use, like rent, insurance, software, so you get the deduction now while cash is strong. So here is what you do before December 31st. Write off uncollectible invoices, scrap the debt inventory, adapt or confirm your 2500 de minimis policy in writing, and prepay the sensible stuff for the next 12 months before December 31st. This is how you close the year lighter, less tax, and a calmer April of 2026. And here is another simple year-end move that can feel like a deep breath for cash-basis businesses. Stop billing in the last days of December. If you're a cash basis, you're taxed on what you receive, not what you have earned. So those invoices that you fire off on December 28th, if clients pay fast, that becomes this year income and this year tax bill. So for the final week of the year, hit pause. Turn off auto billing, reschedule recurring invoices to the first business day of January, and don't send payment links that could be paid immediately. That small shift moves revenue into next year, which can mean real tax savings and smoother cash flow. And a few friendly reminders so they stay clean. Don't accept December checks you plan to hold. If you have it, it counts. Don't run cards in December and give clients a heads up where in our year-end processing window, your invoice will arrive on January 2nd. Simple and honest. So year-end step, pause December invoicing, reschedule it for January, and confirm auto drafts are off for the last week of the year. Now that you have seen the 10 easiest ways to save before year end, you might be wondering whether tax planning is really a fit for you. So let's take a quick look at who tends to benefit the most from these strategies. So how do you know if you're a good candidate for tax planning? And the simple answer is, if you feel like you are paying too much in taxes, you probably are. And that means you can benefit from proactive tax planning. And here is the clients who typically see the biggest results. Those are US-based business owners who make $300,000 in gross sales per year and paying at least $20,000 a year in taxes. Also high net worth individuals who want to protect and grow their wealth. If you're strictly a W-2 earner, your options are more limited. But if your wages are at least $250K or more, or you have other investments, we still have strategies that can make a big difference for you. The bottom line is this: if you're paying significant taxes every year, you are the exact kind of person who can benefit most from what we do. As I mentioned earlier, our tax plans don't just save you money, they also help reduce your audit risk, because everything we do is structured, documented, and IRS approved. Our tax plans typically deliver at least 200% ROI, but in many cases, it's much higher. It can go as high as 500% to even 1000% ROI on what you pay to us. So basically, you keep much more than what you pay us for the service. Think of it this way: for every $1 that you invest in working with us, you can expect to reduce your tax bill by between $2,000 to $10,000. Many of our clients end up cutting $20,000 to $50,000 or more off their taxes every single year. Imagine what that could have meant for your business, your family, and your future. So how can we actually help you to stop overpaying the IRS? We have 3 options depending on where you are in your business journey. Entity analysis and owner compensation optimization, $2,500, perfect if you're just getting started or want to make sure your foundation is strong. We will set up the most tax efficient entity structure and optimize your pay, how you pay yourself to minimize taxes. A comprehensive tax plan only, $5,000. And by the way, I think we're running a promotion right now. Instead of 5,000, it's 3,000 through the year end. This is for established businesses. This is a full standalone tax plan. And you can keep your current CPA for compliance, and we will be your strategist to ensure you pay the least amount legally possible. And all-inclusive ongoing tax planning, $1,000 per month. This is our most popular option. It includes a comprehensive tax plan, unlimited advisory, quarterly projections, ongoing updates if laws or your business change. And it also includes filing your business returns to reflect the strategies that we put in place. The bottom line is whether you are just starting out or already established, we have a level of service that will fit your needs and deliver a significant return on investment. Also, we are launching very soon a do-it-yourself service, which would be very affordable for businesses who make $250K or less in gross sales a year. And if you're interested, please send us a message and we can send the details. And it's in beta stage right now. For first 5 people who signs up, we actually will be given even a discount in exchange for feedback for this program. Okay, so now that you have seen the different ways that we can help, let me show you what this looks like in real life. And here is a quick story from one of our clients who felt the same way you might be feeling right now, and what happened once we started working together. It's, I think, 30 seconds feedback.
Hi, we were a startup about 18 months ago, spinning off from a company I'd been with for 20 years, and custom accounting really helped us set up all the systems that we needed. Worked with QuickBooks, provided excellent comprehensive tax advice both for us as a company and for me personally. They've been quick, they've been responsive, they've been thorough, they've been accurate, more importantly. Probably one of the best decisions I made as I launched my company about 1.5 years ago.
Okay, at this point, I would love to open it up for your questions, and please type them in, and I will answer what I can right now. And as a reminder, if you're thinking of your question, don't forget our limited time offer is only available if you book before the webinar ends. So yeah, please type in your questions and let's dive in. If you don't have your questions ready now, you can always email if you attended this webinar, and I will answer them for you after the webinar. Okay, I don't think we have any questions at this time. So before we wrap up, make sure you scan this QR code if you want to benefit from the special offer for this webinar attendees. Free diagnostic meeting with a CPA for review of your past tax return to uncover missed savings and personalized estimate of your annual tax reduction potential, all at no cost, but only if you book before this webinar ends. All right, it looks like we don't have any questions. Again, send me them in if you remember something to ask later on. I will be happy to answer. And before we wrap up, let me leave you with this. You just seen what's possible to legally slash your tax bills and now it's your turn. So don't let the IRS keep what's yours. If you need help, scan QR code, make the meeting with us, schedule the meeting, and we will be happy to discuss the opportunities with you. Thank you so much for joining me today, and I truly look forward to helping you keep more of your hard-earned money and achieve your financial goals. Have a great day, and hope to see you in a strategy session very soon. Happy holiday season, and bye for now.